how to optimize all of your clients' assets. Now, in this episode, I'm going to talk about asset optimization, tax minimization, and when we talk about asset optimization, we're talking about increasing financial assets, liquidity, safety, rate of return, and tax benefits. If you cannot increase those four key elements of a prudent investment, you basically don't have any business advising somebody to reposition money from where they have it if they're already experiencing the utmost liquidity, safety, rate of return, and tax benefits. But any assets that they're not, you can show them how they could do better by moving the money, repositioning it into a property structured max funded IUL. And that's what this episode is going to teach you. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of people, mostly in America, optimize their assets and minimize taxes. Now, if you understand my firm, which is really three-dimensional wealth, we also optimize the assets in their foundational category and their intellectual. I'm talking about their heritage, their faith, their beliefs, their wisdom, their knowledge. I focus on all 3 dimensions. In this episode, I'm talking about the financial dimension, okay? So when I sit down with a client for the very first time, I'm asking myself, am I going to optimize all of their assets? I'm not going to go try to hog all of their assets. I'm simply going to ask their permission. Would you like to see an illustration of repositioning the money you're currently putting here or that you have here in order to increase the liquidity, safety, rate of return, and tax benefits? That's called asset optimization. And they don't have any objection to seeing an illustration of it, okay? So I'm going to show you what I'm talking about. There's usually 8 asset categories that I am analyzing when somebody comes in, and so they bring their tax returns, their IRA 401k statements, their non-qualified investments, stocks, bonds, mutual funds, or whatever, their real estate holdings, how much they owe on it, and so forth, because I'm an asset optimization specialist. So their retirement planning, college funding, business, estate planning, capital transfer, you'll see what that is, pension maximization, I'll explain what that is, mortgage planning, and life insurance. There's 8 asset categories. Now, when we design IUL, this is the percentage of the total premium, the guideline single premium, which if you don't know what that is, that's the amount of money that they want to be grandfathered to be able to reposition into an IUL to increase the liquidity, safety, rate of return, and tax benefits on that money, okay? 40 to 60% of the IUL cases that we do, the money comes from money that was in IRAs or 401ks. We're doing a strategic rollout, or money they were contributing to IRAs and 401ks that they realized it's better to put it over here in a rich person's Roth, which is what savvy CPAs and tax attorneys call IUL. But also money they're socking away in college funding makes up 5 or 10%. Business working capital, estate planning, capital transfer. I'll share with you what that is because 10 to 20% of all our premium comes from that. Pension maximization. I'll explain what that is. Mortgage planning. This is money that people have in real estate that they just want to sell the real estate and they don't know what to do with the money, or it's money they're sending in extra principal payments to the mortgage company to try to get it paid off, and you can do better by putting it into an IUL, and you can show them that mathematically. And then money that they're spending already on insurance that is not performing very well, and by you doing it correctly, it can perform better, so you want to reposition that money, okay? So when I would meet with clients, I would fill out what I called a green sheet, and I developed this green sheet. You don't have to use this. It looks pretty complicated because I wanted to have somewhere to write down any asset that we would consider repositioning. Here, I would write down their basic information, their age and their income and everything like that, and then the children, the dependents they have. And then over here would be their real estate properties because most of my clients had non-owner occupied rental income real estate, okay? Sometimes they had a home and only one or other two, maybe a secondary home or a condo or a cabin, but it could be rental properties. Over here, I put down all of the money they're putting into qualified accounts like IRAs, 401ks, 403bs, TSAs, and what have you. Here's how much they're saving on a monthly or annual basis towards long-term goals. Here's all their life insurance. Here's their current assets that are non-qualified. These are CDs, stocks, bonds, mutual funds, what have you. Here's their current liabilities, what they owe. And then down here, I had up to 6 different hypothetical situations, goals that we wanted to accomplish. And to give you an example, when I'd get through interviewing and fill out these green sheets, I would simply say, Jim and Mary, the first illustration that I would recommend when we meet again is to show you how much better off you could be 5, 10, 15, 20 years down the road and all the way to age 120 if you live that long, by repositioning these assets that we've identified together today as being underperforming, non-performing. They do not meet liquidity, safety, rate of return, and tax benefit tests, as well as IUL can. And so I would recommend that I create an illustration just repositioning the underperforming, non-performing assets into IUL without increasing your current outlay 1 dime and show you how much better off you would be down the road. Would you like to see that? I've never had anybody say, no, I don't want to see how much better off I would be. No, it's a no-brainer. The next illustration, number 2, would be if I do that, and at the given age you gave me, age 62 or 65 or 67 or 70, whatever they told me they wanted to sit back and retire and live off of what they've accumulated, I'd say, now if by doing that, we don't achieve the goal of retiring by age, let's say 67, would you like me to calculate how much more you would need to sock away in order to retire at that age? Or I could show you, well, you might have to wait until age 70 to retire to hit your goal. And usually they would say, I'd like to see both. So there's illustration number 2, illustration number 3. So at a minimum, I would do 3 illustrations. And then on the second appointment, they may say, well, what if we did this? What if we sold this property or whatever, okay? So that was the magic behind really writing 10 times the case size by being an asset optimization specialist. So they would come to the first appointment with their tax returns and all of their account statements. I would find out their income, their taxes, how many children they have, the type of qualified accounts, IRAs, 401ks, how much they're contributing, how much is in there, and what have you. Their current assets like CDs, annuities, money market stocks, bonds, mutual funds, and what have you, and what their average rate of return is and what they think it is versus what it actually is, how much they owe on everything, their life insurance, the type and cash values, and then real estate, the fair market value, the mortgages, and the cash flow. That pretty much covered it. And so if I'm an asset optimization specialist, I'm going to analyze these assets on the first appointment on those green sheets. And then I'm going to say, now, if I were you, I would look at repositioning this or selling this piece of real estate. It sounds like it's an albatross around your neck. You're sick and tired of taking out the trash and evicting tenants and fixing toilets. Would you like to sell that piece of real estate and just get it over and done with instead of continuing to try to make a profit on it or what? Absolutely. We would love that. We didn't know where to put the money, and we've been hesitating because we've been doing 1031 exchanges, and we're not going to be in a lower tax bracket. And it sounds like, the president's changing the tax laws, and those are all going to be for naught anyway. And so they start making decisions, and they realize that I'm there to help them optimize their assets by doing what? Increasing liquidity, safety, rate of return, and the tax benefits. So once I analyze all of that, I'm helping them understand that IUL is like a financial Swiss Army knife. It's got several uses. It is the dream solution, but sometimes I'll pull out this mind map and it shows 38 advantages to IUL over where most people have their money. Several are under liquidity. These are the first subcategories: liquidity, safety, rate of return, and then death benefit, the legal advantages and tax advantages. But there's a total of 38 advantages. And so I said, I'm going to be suggesting you reposition underperforming assets over here because of all of these advantages. Does that make sense? Yes. Okay. So this is usually the question I would be asking them when they came in. Now, most clients, before they come in, I give them homework. And I'll have them read the book, The Laser Fund. It's 300 pages. But if they can't get that read before they come in, even though I sort of snicker because some people say, wow, to read this 300-page book is going to take me 6 hours. 6 hours. And I'm like, most people spend more time planning their summer vacation. They take more than 6 hours planning their summer vacation than they do their whole financial futures. Isn't that worth 6 hours? But okay, then just read chapters 6 through 10. That's about a 90-minute, 2-hour read at the most. Okay, we'll do that. So they usually have read chapters 6 through 10 of the left brain side of the book, maybe one chapter out of the right brain side of the book. And then I usually have them watch 3 up to 11 YouTube videos. These YouTube videos are usually 11 to 15 minutes. Now, if they come to the first appointment having read and watched, oh my heavens, they're like up here. Now they're getting it. They understand TIF for different TAMR, and they're almost ordering their IUL policy. But I don't have to go back and spoon feed them education about TIF for different TAMR and all the lingo. They already know that. Now I can just make sure they understand it in about 10 minutes and move into their numbers in the second appointment or even the first appointment. But if I have to start from scratch teaching them about max funded IUL and why it's better than IRAs and 401ks, that takes an hour and a half. I would rather have that all done before they come in. So that's one of the secrets. So then we sit down and I'll usually ask them, well, Jim and Mary, after reading the assigned chapters in the Laser Fund book and watching the recommended YouTube videos, what did you want to accomplish most from our first visit here today? Now, you wouldn't believe how many times they'd go, wow, most financial advisors don't ever ask us anything like that. In fact, most advisors spend the first 20 minutes talking about how great they are and the alphabet soup behind their name and all their accolades and all their achievements. That's what I teach advisors. Folks, it's not about you. It's about the client. It's about them. So this is about them, not about you. It's so refreshing to them. So let's say this is a 55-year-old couple, and you would be surprised that about 60 to 70%, when I ask the question, say, well, duh. Whatever we do, we want to check into getting one of those IUL policies that you talked about in the book and the videos. They've already bought into the concept that IUL is their dream solution, okay? Now they just want to see their numbers. But they may also say, well, to be financially secure, so that we can net $300,000 per year in after-tax income and not outlive our money and being able to enjoy retirement well into our 90s and even to age 100 if we live that long. This is a very common response, okay? So when you meet with clients and you're wearing the hat of being an asset optimization specialist, I'm going to give you a real quick version of the questions you ask, and this will 10 times your practice. You're not hogging their assets. You're simply finding out what assets are underperforming, okay? I don't have time to teach in this episode how to do what I'm talking about here. I want you to focus so that you can learn how to optimize people's assets by asking questions. So here we go. I go around the financial Swiss Army knife because I say, you know what? Property structured IUL is like a financial Swiss Army knife. It's the dream solution to many financial goals. So let's go through your assets and identify those that are underperforming or non-performing that you could increase the liquidity, safety, rate of return, and tax benefits. And then I can create illustrations to show you how much better off you would be. Does that sound fair? Again, they're not gonna say, no, that doesn't sound fair. So we start with retirement planning usually because most people come and say, well, we want to sock away $2,000 a month into an IUL. That's $24,000 a year. So if you understand how to structure it correctly, you times it by 11 years under the TEF for DEF tax citation. So that's $264,000 because they told me they want to retire in 12 or 13 or 14 years, right? So that's $264,000. I write that down. That's part of the GSP. Now, if all I did was stop there, because that's all they came in to check out, and you can't believe how many advisors stop there because you didn't ask them the questions. Well, they didn't ask me, can we reposition this and that? No, you have to ask them. Okay, so that's 264. Now watch how I end up with 10 times that. I go next to real estate management, and I simply say, are you sending extra principal payments against mortgages on your real estate? Yeah, we send an extra $1,000 a month. Is that for the purpose of getting out of debt quicker? Yeah. What if I could show you could get out of debt 2.5 years faster by not giving it to the mortgage company and killing your tax deduction, but putting it into IUL where it's compounding tax-free versus killing your tax-deductible mortgage interest? Oh, yeah. Okay. So I'll reposition that. That's another $1,000 a month. That's $12,000 a year times 11 years is $132,000. If you don't understand what I'm doing right now, you need to learn how to properly structure IUL. Do you have any real estate rental properties that you're sick and tired of? Oh, we've got one like an albatross around our neck. We want to sell this rental home probably in the next 2 years. And we'll net at least $400,000. Would you like me to make room, grandfather you for $400,000 to go into an IUL? Yeah, sounds good. Okay, so $400,000 plus $132,000. Then they tell me they're planning on selling their home that is free and clear of a mortgage. They paid off in about 5 years, and they're going to then buy 2 small retirement homes, one in a summer climate and one this warm in a winter climate, which many people do where I'm from. And so they're going to sell their home for $1 million and buy 2 $500,000 retirement homes. And they read my book and they said, until we read your book, we were going to just pay cash for these 2. We'll be ruining the opportunity to deduct the interest on those 90 days after we do that. Would you like to see only using 20% of that $1 million for a down payment and repositioning the other $800,000 into IUL? And it will actually resurrect some tax deductions that I think will help you get your money out of your IRAs and 401ks tax-free. Yes, we want to see that. You'll see me come around full circle to this. Okay, so far so good. I got 400 plus 132. Then I say, oh, I see you're a business owner, Jim. Do you keep working capital accounts for what you're doing in your business? Oh yeah, we have a couple of $100,000 that we keep on hand as working capital. How much of that that $200,000 do you normally dip into? Oh, most of the time only about half that. Well, if you could get the other half within 3 or 4 days, if push came to shove out of your IUL policy, is that liquid enough? Oh yeah. Would you like to reposition half of your working capital account, $100,000, into an IUL so that you can get a better rate of return and it has liquidity? Maybe not a drive-up window that you can go to in an hour, but you could get that $100,000 within a few days. Oh yeah, most emergencies don't require, any more than a week or 2. Okay, so I add another $100,000. Are you saving any money for college for your kids and grandkids? Yeah, we're saving $1,000 a month in 529 plans for 2 grandkids. Do you know if your grandkids get a scholarship and they don't need that 529 money and they want to use it for a down payment on a home or to start a business, now you have to pay tax? If it's in an IUL, you don't have to. And if you happen to die, the 529 plan is funded in one fell swoop. Do you see why it knocks the socks off of a 529 plan? Oh, yeah. Would you like to reposition the $1,000 a month you've been putting into that into your IUL? Yeah, there's another $132,000. Oh, what about an emergency fund? Do you keep money in a bank or credit union on hand for emergencies? Yeah, we usually keep $100,000 in the bank. Well, again, the drive-up window's there, but how often are you going to need all 100? Oh, if we could grab 50,000 in an hour at a drive-up window, that's fine. But we realize that even at a drive-up window, a bank or credit union, if they want to, they could say sorry for 6 months. Yep, you're right. Would you like to reposition 50,000 of that into an IUL? Absolutely. Oh, let's look at lump sum capital transfer. Do you have any anticipated lump sums from a settlement from a car accident, or maybe you're going to retire and get a lump sum option or an inheritance? People, you can't believe how many people go, oh yeah, my wife's getting $250,000 and an inheritance here. I go, would you like to make room for that $250,000? Yeah, we haven't thought about that yet, but we're wondering what should we do with the money? Well, I would recommend you keep it tax-free. Okay, let's do that. Are you seeing what's happening here? I'm just asking questions. Well, it looks like so far to reposition this much, you're going to end up with a death benefit of $4 or $5 million under TEFRA and DEFRA. And we're structuring it so that basically otherwise payable tax is paying for that insurance. So if you get $5 million of insurance, that could probably solve your need for insurance. How much insurance do you have right now? Well, we have $1 million term policy that we're paying $250 a month for. Would you, if you get approved here, would you like to just get rid of this one? Yeah, this is gonna keep going up in price. Okay, so now we're gonna reposition that $3,000 a year. What about pension maximization? Oh, your wife was a school teacher for 30 years. Yeah, when she retires, she gets a defined benefit pension of $5,000 a month based on her years of service. Well, that's if she chooses the no survivor benefit. But they're gonna have a little talk with you and they're gonna say, if you take $4,000 a month, let's say, instead of $5,000 a month, then she'll get $4,000 a month as long as she lives. But if she dies, you'll keep getting the same $4,000 a month. Don't you want to do that? And most people go, yeah, I guess. And you just bought the most expensive life insurance policy you'll ever buy. You don't need to do that. You should keep the $5,000 a month benefit and take that extra $1,000 a month that you're getting and put it into the IUL. And now you have all kinds of flexibility. Because if you die before she does and she gets remarried, she can't name her new husband as a beneficiary. There's only one beneficiary. She has to die first for you to get it. And when she dies, if you're not around, the kids are disinherited. An IUL, you don't disinherit anybody, okay? Oh, that makes sense. So let's take that $1,000 a month and put it into the IUL starting in year 5 when she takes her pension. The last one is tax reduction. Let's come full circle here. They have $300,000 in a 401k. They think it's going to keep growing at 6%. That means it'll go to $368,000 by age 59 and a half. If we start a strategic rollout in 5 years after age 59 and a half to avoid the 10% penalty, we roll out $50,000 a year for 10 years. And guess what? We simply use that $50,000 to service the interest on the 2 $400,000 mortgages on their 2 new homes in trade-off for the $800,000 that we put into the IUL when we sold their house. And guess what happens? We roll out $500,000 over 10 years tax-free out of your IRAs, your 401ks. Would you like to do that? And the $800,000 that we put in the IUL doubles to $1.6 million. This is incredible. Would you like to do that? Absolutely, because what do? They read stories of how we did this in the book. What does this all mean? As an asset optimization specialist, now I take year 1 and I have the inheritance, the business working capital, the emergency fund, I have their month, and I have $451,000. And then I have another $451 because they're going to sell the rental in the second year plus the monthly. The third and fourth year, we only are going to put in $51,000, no big deal, but if you don't use the other $400,000 of room, you don't lose it. So in the 5th year, we can put in that $800,000 from selling their home. And then we keep putting in $63,000 a year for the 12 years, and guess what? The bucket size now is $2,233,000. We 10 times the bucket size by optimizing all of their assets. Are you getting it? The minimum death benefit was $5 million. They only had $1 million of insurance before, but they're not having to pay for this. It's being paid for with a minuscule portion of money that would otherwise go out the window in taxes if they kept their money where it was at. Is this making sense? The cash value projections at age 67 or 69 allows them conservatively with a 9% or an 8% payout to hit their goal of $300,000 a year of tax-free income without depleting principal if they live to be 120. It's a no-brainer. This is called asset optimization. We teach it in the book. So if this is blowing you away, hopefully you'll want to go, wow, I want to learn how to be a professional. I want to be an asset optimization specialist and a tax minimization strategist. So learn, the first step would be to claim your free copy of the book, The Laser Fund. It retails on Amazon for $20 or more. If you buy it on Amazon, thank you. But I'll gift you one free. You simply go to laserfund.com or click on the link below and contribute a nominal amount towards the shipping and handling. I'll cover the rest of that and I'll pay for the book. I will fire out a hard copy of this 300-page book to you via priority mail. This side is the left brain side, 200 pages, 14 chapters, charts and graphs. If you're a right brain learner, you flip it over. This side is about 100 pages, 12 chapters with 62 actual client stories, people that learn by stories. If you want to use your whole brain, you can read both books, okay? Now, while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's options there. You can register for a free educational webinar. You can even schedule an appointment to talk to an IUL specialist, a certified IUL professional, which is in the top 0.1% of IUL agents, because you'll be assured they know how to do it the way I'm talking, how to structure it correctly. So this is not about me. This is about you and your brighter future. Hopefully you've gained insights on how to optimize all your clients' assets.